Matt Orton is the chief market strategist at Raymond James. Good to see you again. I mean, is that kind of your point of view that geopolitics in some ways, or at least this time around, just creates noise that lets you buy into what, in the long run is a rising stock market?
It's always great to be here, Kelly, and that's exactly it. I think when you see these periods of uncertainty, which frankly we haven't had that much of downside in the market so far during everything that has transpired over the past 2 weeks or so, you want to lean into dips because the fundamentals that are both underlying this economy and the market itself, incredibly strong earnings growth, record profit margins across the S&P 500, even small caps finally having earnings growth that's likely to exceed that of the S&P 500 this year. Those are really good underlying fundamentals. So when the market gives you a chance to get in at a better level and actually buy low, that's what we should embrace as investors. But the key is being selective because not everything is created equally. And you want to lean into longer term, durable, secular growth trends that aren't going to be disrupted as much by some of the uncertainty that we have playing out.
I like where you took that, where it's a broadening out of performance. And the companies that are the 493 of the S&P 500, their earnings growth projections are going from 6% to 12%, or maybe even higher in some cases, while the large cap is going from 40% all the way down to 15%. We said this to the first guest that was on. Does that make you encouraged? Which it does. But what my pushback would be, 40% of the market are the large cap. The market goes where they go, not where the others go.
That's exactly right. But a lot of the large cap companies still have that positive second derivative with respect to where their earnings growth is taking place. You look at some of the big tech companies, you look at an Alphabet, for example, their earnings growth is still incredibly strong and continuing to accelerate higher with a very, very diversified businesses. So again, it comes back to this idea of selectivity, right? You can still own some of the large cap companies. They can tread water, frankly. And as long as the rest of the market continues to see that very, very strong earnings growth, you can have the market push higher. But to your point, Steve, you need at least some of the market leadership that we've had in the past to start to work again. And I think it will. And whether it takes, this crisis to play out or the next earnings season to see an ROI that some of these companies are getting on the massive CapEx investments they're making, I think we're going to see that play out. And I think that will be the catalyst to start getting this market to move higher, including some of those larger names.
You say the biggest opportunities are select tech, industrials, and high-quality small caps. And your biggest concerns are the consumer staples and the financials, which we've been having a lot of debate about the past couple of hours. Why the financials?
So financials have been concerning simply because of private credit. And we could spend a whole segment going into what's right and what's wrong about the messaging with private credit. But I think for some of the higher quality managers, the concerns are overstated. But when I look at the price action of the banks, the BDCs, insurance companies, it's not constructive. And so that's not an area that I think we need to wade into. But when you look at the flip side of other sectors like technology, semiconductors, names like TSM, which are some of my favorites that are down over 10% from their all-time highs, but are going to benefit from all of the things that we see playing out, including the numbers that Jensen was talking about yesterday at GTC. You also look at some of the memory names, the optical names that are going to require big investments. Tech is still a place to be. You just have to be selective with where you want to go. And industrials benefit significantly from this big CapEx super cycle that we're in. So I like electrical equipment companies. I like a lot of the companies that are early site developers for data centers. These are places to be in industrials, and maybe avoid some of the early cycle cyclicals that could be impacted by higher energy prices in the short term.
Yeah. What do you think, Grasso?
Yeah, I do like the broadening out theme. I think that there's a couple of things. The big, beautiful bill, I think, adds a tremendous tailwind that no one talks about, right? Full expensing. And I think the lower permanent tax rates really help the companies that need it. But we do have a couple of refi walls that Kelly and I were just talking about for the smaller companies. That could get in the way. And I think it depends on where rates go. So if we believe we're in a sideways, no one's saying higher. If we believe we're in a sideways rate environment, how does that affect your scenario if rates don't come down? Because obviously that inflates all risk assets.
It does, and that's perhaps a reason to avoid some of the more sensitive consumer names in the market. You've seen a huge run in consumer staples that I don't know is quite justified by the actual fundamentals. Maybe if you strip out Walmart and Costco from that, because the lower end of the consumer is going to be more impacted by higher rates. At the same time, when you look down market cap in the small cap space, there's a lot of companies that aren't dependent on where the spread for interest rates is because they're already free cash flow positive, they have earnings growth, or there's other big secular growth tailwinds. You were talking about pharmaceutical patent cliffs, acquisitions in biotech. That's less dependent on the interest rate environment because large pharmas have 30, 40 billion dollars worth of cash on balance sheet to make acquisitions. But interest rates will matter, especially for lower quality companies. So this is an environment to skew up quality with a lot of companies. You can still get growth and high quality at the same time.